A warm good morning to my team. I'm so happy to be here. So we'll be starting in another 4 minutes. So if you can talk to your team and ensure that they are online as well, and if you guys can turn on the screen, turn on the camera, sorry, and attend with a pen and a paper. We'll be discussing some amazing things in our training today. So we'll be starting in another 4 minutes. Hello everyone. Warm good morning. Super excited to be here. So if you guys can, if you are not driving or if you are not at work, if you guys can turn on your video, it would be much appreciated. I'm so super excited to share this information with you guys because when you have the videos on and when you are taking the notes, that is when you are gonna get the most out of it. Otherwise, there is no point of you attending if you are distracted somewhere, isn't it? Are you guys agreeing with me? And also, I don't want to be this like a typical teaching session or anything. I want this to be an interactive session. So you can just feel free to ask me questions, anything you can put it in the chat box. We are going to have an at the end we are going to have a Q&A section as well. All right? Sounds exciting. All right. So today we have so many things to cover and a very little time. So first I want to talk about, it's more about life insurance. We are talking about a product called life insurance mainly here. Okay, so in life insurance, first we will talk about what is insurance, then we go into deep in all of those things. So how many of you are familiar with life insurance or any kinds of insurance? Can I see like a hand raising or anything? Auto insurance, some of you might already have, isn't it? So most we are quite familiar with it. We are always using this and all those things. But what is exactly life insurance is? Life insurance is to protect your life. That's the main thing. So before that, going into that topic, let me just talk about something. What is the need of a life insurance? So if you look at as a life insurance as a whole, before there is two types of need. There is a temporary need and a permanent need. And if you guys are also preparing for the exam, these would be very important points for you to remember as well, because you might get some questions from what I'm going to talk. Okay, and there is temporary need and there is something called a permanent need. So what is temporary need is if you know a definite time where that need is there, like if there is, if one of your today or tomorrow you all are going to get the license and you will be dealing with the people. So one of your client is going to say, okay, I need insurance for next 20 years because my kids are right now very young age, and until if something happens to me, I want them to go to college. They say something like that. That is a temporary need because you know exactly until when that need is. That is for the next 20 years. If are you guys following me? Okay. I like to have some reactions in the comment box or anything. Otherwise, I'm just only one way, right? And the next one is something called a permanent need. Permanent need is very simple. If one of your client is saying, I want it, if something happens to me, I want my family to have this much money. And nobody exactly know until when something is gonna happen for them, right? So that is considered as a permanent need. If you don't know exactly a timeline, that is something called permanent need. So I'm just gonna share my screen. Just allow me 1 second. Can you guys see my whiteboard? Okay, perfect. So like I was saying, there is in, insurance, there is temporary need, and there is something called permanent need. Okay, so for a temporary need, what we usually give is something called a term insurance. Term insurance is nothing but it is for a particular period of time. It can be 10 years, it can, that's called a T10, it can be 20 years, it can be 30 years, it can be 40 years. If it is for a particular period of time, that is called a temporary term insurance. T10, T20, T30, all of them are example. The next one is something called permanent insurance. There are two types of permanent life insurances. One is universal life and one is something called a whole life. Okay, universal life and whole life, those are the two important, those are the permanent insurances. And the one of the beautiful thing about these ones are, these are not just insurance, these are investments and insurance combined together. Some of the people who are in the call might already have a universal life, some of them have a term, some of them have a whole life. You might be already familiar with it. All right, so before I go into the next topic, I want to explain something called estate. Are you guys excited for that? Okay, Google, do you have any questions, brother? Because I can see only George and Google's video, so I will ask questions to you guys if you don't mind. So I want you to unmute yourself. Okay, can you do that for me?
Yes.
Okay, perfect. Okay, so we will just do like a Q&A session, right? I'm gonna ask you some small questions, just nothing related to the topic or anything. You just reply to me. All
Okay.
right? Okay. 1 second. Let me just. Okay. Okay, Google. So let's say you are to. Did you complete any exams yet, Google?
Yeah, I did complete ethics and I am just preparing for the accident and sickness right now.
Okay, perfect,
And
perfect,
doing mock test and everything.
perfect. Perfect. So you might be familiar with some concepts. So I'm just gonna explain a concept, something called estate.
Estate, okay.
Very important concept for you to learn. Not just for you, for everyone. So Google, let's say if something happens to any person, if a person dies, everything belongs their name. It can be their bank account, it can be their home, it can be their any asset like car, anything, businesses, everything will be going to some place called estate. Okay, Google.
Hmm.
Think it estate as like a big pond. If a person dies,
Check out this Scissor radio mix on Spotify.
I'm sorry. You guys can mute. Okay, thank you. So if a person dies, everything goes to the something called estate. So
Okay.
just consider this as a big pond. So what will happen after that? That is a big question, right? So if it goes to estate, the first person who has access to the estate is something called creditors. Okay, creditors is, let's say that person has some kind of debt. Let's say there is a home loan pending or some loans are pending. They will come and take the money out from the estate first. Okay, Google. The
Yeah.
next is something called capital gain taxes. Okay, capital gain taxes, I will just quickly explain. Let's say you are buying a second home. Let's say you bought that for $500,000. After 10, 20 or 30, whatever years, now it is, let's say, 1.5 million. So what is the capital gain over here? How much you gained? That is, the difference is $1 million.
Yeah.
Okay, so you will be paying taxes for half of the amount, that is $500,000. Actually, there are some minor changes to that one as well, but we will just stick with the 50%. Will be taxable. That means you will be paying taxes for $500,000, which is half of the capital gain.
Okay.
Following me, okay?
Yeah.
So which would be around $260,000 as just as taxes.
Okay.
Okay, so now the creditors take the money out from your estate. Now the capital gain taxes came in, and there is something called a probate fee or probate, you can call it. Okay, after all creditors and capital gain tax, Google, you will be paying around 1 to 2%, depends on the province, to the government as probate fee
Okay.
to the entire estate. That means, let's say your entire estate, that your client's entire estate is worth $3 million. After capital creditors and capital gain, let's say it is worth $2 million. For that, 2% will be just as probate fee. Okay, and the next thing, after this, it will be distributed according to the will. If there is no will, that is another mess. They have to put an executioner, there is court fees, and all those things will occur into the estate as well. Okay,
Okay.
you follow me?
Yeah.
Wait. Okay, perfect. So if there is no will, there is extra fees and there is so many headaches. Just think it like that way. Okay. So what? So we know that it is not good that something goes to the estate, right? Because creditors are there, capital gain is there, probate fees, all those things are there. So actually there are couple of things which can bypass the estate. What does that mean is it is not going to go to the estate if someone dies. The first thing is something called a spousal rollover. Okay, Google. Okay. So George, why don't you unmute? Oh, let's go to George. Actually, he is also my teammate as well.
Hi.
Okay, George. So if something happens to a spouse, let's say John and Mary is there. If something happens to John, everything will go to the Mary. There, it won't go to the estate. That is the first thing which bypass the estate. Okay, George.
Okay.
Okay. The second thing is something called registered accounts. Registered accounts in the sense RRSPs, TFSAs, etc. So all these account you can name a beneficiary and it will go to the beneficiary. So if there is no beneficiary, where will it go? It will go to the estate.
Mm-hmm.
So it's a good idea to have a beneficiary for your registered account. Okay. And what is the third thing? Is nothing but life insurances, segregated funds, annuities. Annuities, just think annuity is like a GIC. Exactly, annuity is a GIC. And with a beneficiary. So if you name for your insurance, if you name a beneficiary, where will it go? Will it go to estate or it will go to the beneficiary?
Obviously, go to the beneficiary.
Beneficiary. And will there be any trouble of creditors or capital gain tax or probate?
There will be nothing.
There won't be nothing. So that is a beautiful thing with the life insurance. Segregated fund is treat this as a fund which is managed by insurance companies. Okay. And then there is annuities. And is there anything else? There is actually.
There is someone asked something in the chat.
Yeah, I will look into the chat.
Yes.
Okay. Then what is the fourth thing is, let's say there is two person, there is John and there is another David. Both of them bought a house together. Okay, and there is something called, there is an agreement between them says if something happens to one person, it will go to the other person. It will also bypass the estate. Okay, I'm not gonna go much detail into that one because that is out of our scope. We will be learn mostly about all these things.
Okay.
Right. So let's look at the chat because okay, let's see. Can the asset be rolled over into the children beneficiary instead of spouse? Unfortunately, no. The assets can only roll over to the living spouse. There is no way we can transfer it to the children without going through the estate. And one more thing is, let's say what will happen when both spouse died? That is a big question, right? Then everything will go to the estate. When one spouse died, everything goes to the other spouse. When both of them died, everything goes to the estate. All right. And there is so many instances you need to be very careful when you're if the client is not very careful, the estate might not settle for next 2 or 3 years. What will happen is there are cases where children are fighting, or there is ex-wife and all those things. If there is no proper will, sometimes the estate settlement process take up to 2 or 3 years. And what will happen is, if John died, even there is $1 million, hear this importantly, even there is $1 million in his account, nobody can touch it. If he dies and there is $1 million in his account, nobody can touch it until the estate solves, like settled. So it's a very important to have a living will as well, a proper will as well, which we can help. So if any of you doesn't have a will, talk to your trainer or your SMD, they can help you to set up a will as well. So those are very important things.
So one more question. If the will is still existing and this both spouse, means husband and wife died, it automatically goes back to the children or back to estate?
So what will happen, George, is when there is a will, everything will go to the estate first. Then to the creditors, capital gain tax. After the probate fee, it will be distributed according to the will. So if there is no will, that's the issue. Then there is a separate person will come and execute in a standard way. That might not be the right way the intended way of the deceased.
So either the will is existed or not, it all go back to estate once they have passed away. I mean, the both spouses passed away.
Exactly.
So what is the difference between then will existing and not?
Very simple. So let's say there are a couple of assets. Let's say there is one house, there is another house. Two houses both are different values, and there are two children.
Okay.
And they are gonna fight each other, isn't it? Okay. I want more. And
yeah.
There might be an ex-wife.
Okay.
They are gonna come. All those things we can eliminate if we have a proper will. And also one important thing, if any of you guys have kids, very important thing is, if you don't have a proper will, if both of them are not alive, who is going to take care of the kid? That is a big question. That can that can easily be solved by having a proper will.
Okay.
If there is no will, it has to go to court and all those headache.
Get it. Get it.
They are not
So
easy.
if the will exists, then it will go back to estate first and it will come back to the children. Is that the way it's going?
According to the will, yes.
Okay.
First estate, then according to the will, it will be distributed.
Okay. So my second question, if there is a lot of people are like single mother or single dad concept in the Canada, right?
Mm.
So they don't have any spouses.
Mm-hmm.
So that will be applicable to the same way, right? Once he expired or he passed away, this goes back to the estate and comes back to the children, right?
Yeah, according to the after credit capital,
according to the will.
everything probate according to the will, it will be.
Okay. Okay.
Let me check the chat as well. What if there is no spouse? Okay, yeah. How the children name under the asset? So that is another big discussion. We don't want to put everything in the children name. So those who doesn't have do have children, sometimes there are so many things happen. You don't want everything in their name as well. It can be taxable for them as well. And sometimes people don't like to do that. I don't want to go more deep into those family problems occur sometimes. All those things might happen as well. Okay, so I think okay. If you wanna unmute yourself and ask the question, it can be done as well. So when I'm going back into the chat, I lost my concentration as well. Okay. So the next concept is we have talked more. So what can bypass the estate is something called life insurance, segregated fund, annuities. These can bypass easily, and also all the registered funds. So why we need to go for a life insurance? That is another question which we need to ask ourselves, right? So life insurance, how many of you believe in life insurance? Can I see some reply in the chat box? Nobody believe in life insurance, I guess.
Life insurance is basically the motive is behind something we are concerned about our children or about our future.
Yeah, it can be that one as well. It can be children, it can be future. Life insurance is first thing is it is not an asset or not a liability to you, because you are not getting any benefit of. The only person getting benefit out of it is your family. It can be for your parents, your aged parents. It can be for your spouse. It can be for your loved ones. Anybody. It's just all in the sense it can be for your loved ones. You don't have to believe in life insurance. It's just like life insurance is a wrapper for you. It's like a safety net. If something happens, that is there to protect your family. Just take the example of something called John. John. John is a 23-year-old male, and he is only one kid in the family. He has two parents who are aged. The John came to Canada with a lot of debt. He came as a student with a lot of debt, around like 25-30 lakhs rupees debt, maybe like $50,000 $60,000 debt. And John is there, like, for their families, like poor, not very rich family. They were like okay family. They are like living. That's it. So if something happens to John, who is gonna pay off this debt? Their parents might not be able to. So a insurance in their life actually can support them. Actually, this is a real life example happened in our office itself. It's around 2020. There was just a guy who is like 20 25 26-year-old guy. He came as a student in Canada. He had a basic plan of $250,000. And what happened is he went for swimming and he drowned to death. Unfortunately, it happened. And he has so much debt and everything. Actually, we were able to send their parents a $250,000 check, which I know there are two stresses. One is emotional and one is financial stress. Emotional stress, nobody can deal with it, but it will eventually go away after 5, 10 or 10 months or 1 year of time. But the financial stress will be there forever. the financial stress, we were able to ease it off. And there are so many, if you are in the groups, if you are active in the groups, you can see so many examples of helping families and supporting them as well. All right, so that is one thing about the insurance as well, right? And if you guys have any questions, feel free to ask me. You can unmute Google if you have any question, or any Kumar, Sai Kumar, Fanindran, anybody. If anybody has any questions, Ramandeep, or if anybody has any question, feel free to ask me. Okay. Now let's hope there is not much. Now let's go to the next topic, something called what are the philosophies we work on. So we believe every family deserves financial education and solution, right? So we will work on 3 main principles. So we help families to save 10% of their net income. So let's say there is a family, husband and wife, or a single person who is making $6,000 on an average. We help them to save $600 into various plans. First, we will help them to save. First, what we will do is we will protect their income protection. So the biggest asset for them is the ability to earn income, isn't it? I will unmute one more person. Maybe Harsh, do you want to unmute?
Yes.
Yes, Harsh. So what is the biggest asset for any person? Isn't it the ability to earn income? Because
Biggest
even
asset.
biggest
Yeah.
right. Even they lost a job, they can find another job very easily. Even
Yes.
they have some financial struggle, they can easily go to job. But if they can't go to job and make money, that is very important. So income protection is the first and foremost important thing when we are helping a family. Next one is
100%.
something called income replacement.
Right.
So what if something happens? What if an accident happens? What if the person is diagnosed with a critical illness? Do you think his bill is gonna stop?
No.
There is no way. His bill is not gonna stop at all, right?
Yeah.
What about his car payment?
It's not gonna stop. They're
Rent,
gonna ask for money.
rent,
Yes.
grocery, and what is the one thing stops?
Income.
Exactly. So we will help them to protect their income. The next one is we will help them to replace their income if something unfortunate happens. Then we will help them for generational wealth. And in the income replacement, there is, so when you are retiring, do you think you can just work forever and make money?
No.
There is no way. So when you are retiring, you need income replacements as well. So
Yes.
retirement also one aspect as well in the income replacement part. So if that person is having 600, we are helping them to save $600 into various plans. It depends upon each person's financial need analysis. So financial need analysis, those who are not familiar, it's very simple. We sit with the client and take their goals. We assess their income, we assess their liabilities, we assess their debt, we assess their protection, we assess their, like, do have proper plan for estate planning and all those things, and find the right product for them. Okay, so why we are dealing with almost 80 plus companies, US and Canada together, and we go and check with the multiple companies and find the right product. One of them, and in this, when we are taking the need, we also assess the protection, whether they have proper protection. In that one, life insurance is one of the key factor because that is helping with the income protection. All right. So, and talked about estate.
It's 20 hours.
So I will unmute. Ramandi, do you want to unmute? Okay. So Ramandeep, let's say a person take a T10, that means term 10 plan. That is a life insurance, nothing, but there is no investment, nothing. There is a life insurance. What does that mean is, Ramandeep, if something happens to that person, their family or whoever is the beneficiary, they will receive a lump sum, like a 500,000 or $1 million. Okay, it's for the next 10 years. Okay,
Life is insured for 10 years. After
exactly,
that, if they died, it's not insured, right?
exactly, nothing, zero. Okay, if it's the T10 and there is T20 for the next 20 years, and there is T30 also. And if it happened in the 21st year or the 31st year, zero money will be paid to the family. Okay, so this is a very good plan for those who have a very low budget. So you might be able to get a plan for maybe $30, $40 a time plan. So if they have a very tight budget, they don't have any money to spare. Like some people are running paycheck to paycheck. All right. To start with, the next is something called, we talk about permanent insurance. There is one called universal life and whole life. I'm not gonna go much deep into it. Depends on the circumstances and depends on their financial need analysis. We recommend either universal life or whole life for their permanent protection. So in this one, Ramandeep, they are gonna get a permanent protection. What does that mean is, whenever they die, that much money will go to the family. It can be 1 year, it can be 90 year, it can be 100 year, it can be anything. All right.
Right.
So that, yes, you have a question?
No.
Okay. So there, the client is permanently protected. First thing, and there are two types of whole life. There is something called the par and non-par. There is participating and non-participating. Non-participating is nothing but a T100. That means term 100 insurance. That means for permanent insurance for the rest of their life. That's it. And participating, they get some cash value, they can take it as a retirement wealth, or they can have a long time plan and everything. Same with the universal life as well. There is a permanent insurance plus an investment in it, so you can use for your income replacement. All right, so it depends on the age, and there are so many factors which determines the premium of this. One of them is age. Okay, Ramandeep, the more older you are, your insurance premium is gonna go up. Simple as that. The next is very important is a health. If you are healthy, very good. We can ensure your good health. If you are unhealthy, then we can ensure that one as well. But that is gonna be more costlier. So when your client is saying, "Oh, I want to think about it," it's very simple. Always keep this in mind. If your client can not be insured, maybe in a blood check away. If a blood check came positive with some certain things, they might not get an insurance for the rest of their life. So it's whether a male or a female. That's also matters. That is one of the other criteria as well. Okay, there are so many others. I'm not gonna go much deep into those ones. I just wanna get the basic out to everyone. Are you guys all good, Raman, Deep?
Yes, all good.
Anybody has any questions? Please feel free to unmute and ask. Okay. So when we are designing, I'm going to show you 3 illustrations of term, universal life and a whole life plan. This is very generic and this is not specific to anybody. This is just for you guys to understand how it is differentiated and just what are the main things. I won't be explaining much deep into it. There are a lot of terms which the amount of time which we have might not be enough for everything. Share my
Yes.
And next $500,000. Hope it is written somewhere here. But it is, you can see it is very cheap. If he goes for a 20-year, that means from the age 32 to 52, he will be paying $30. And if he goes for a term 30 or till the age 65, it is only $48 till the age 65. After that, there is nothing. So you can see it's very cheap at the start. And what about the age which you actually need insurance? Do you need the insurance in your younger age or when you are older? What do you guys think? Anybody can unmute and answer.
Younger age.
Younger age, you need insurance. That's true. And but you need more when you are older as well. For your estate taxes and all those things, you need insurances as well, right? So let's say at the age 60, 68, you can see he's paying monthly $518. That is on an average $6,000 for $500,000 insurance. At the age 77, that is $1,400. That is $12,000. He is paying monthly to get the same thing. Even $13,000 here if he has a 20-year term. And you can see it is how it is differentiated and everything. I think I have a chat here. Older, yeah, that is true as well. And the next one is something which is a very typical example of a something called the whole life. Here you are getting the same $500,000 protection, but you are paying around $18,000 per month per year, sorry, for the next 20 years. After that you are not paying anything. But what is the difference between term insurance and a permanent plan is you have money to take out. You can see you can take out, there are almost more than $500,000 you can use it, and your insurance is keep on increasing. And there is a universal life example as well here. This is, he is paying $2,700 every year for the next 20 years. After that, not paying anything. On the start onward, there is $500,000 death benefit if something happens. In 21st year, there are almost $96,000 even with a 7% growth. At the age 65, there is $210,000. At the age 80, there is more than $500,000 there. And if something happens, $732,000 will be go to the family. If the person, when they are alive, let's say they took out from the $500,000, let's say they took out 300,000, 700 minus 300 will be going to the family. That is almost 400,000 will be going to the family. And there is a question. So the monthly premium increases after 65. New, which plan are you talking about? Is it talking about term insurance? The term insurance after your term?
Yeah, term like
Yeah.
after, say, for an example, if you said after 65, you still pay?
For a term insurance, you will be paying every monthly. When you stop, it stops.
Every monthly until 5. So what happens? What happened when you reach 65? You stop paying, you still have the term?
You mean this one? 1030?
Yeah.
No,
Yeah.
you don't get the time. After 65, there is none. And you might not be eligible for another
No,
insurance.
I mean, the 3065.
Yes. So this one, new. After this, you don't have any insurance.
Yeah.
You can't renew it.
Oh, no insurance. Okay.
Exactly.
So, so say for an example, you get your, say for example, a 38-year-old every month, he's paid for the $30.78, right? And does he continue paying until his death, or does until 63 when he turns 63, his insurance increases?
So for the next 20 years, $30.78 per month is their premium for the next 20 years. So after that, it is increases to every month. It is every year. Sorry, every month it is 131 in his 53-year-old. Let's say he is 58-year-old. Every month he will be paying $219. Every month it increases. Okay.
That's the thing here, but sometimes, that's the thing. Sometimes, when they reach a certain age of retirement, their income reduces. How will they be able to afford $219.06 at the age of 58 or at the age of 67 if they're retired?
Exactly. That's a very good question. So that is where something called permanent insurance comes into place now. So when term insurance is very cheap, like I was saying, it is very good for somebody with a very tight budget. But if you need, when you need insurance throughout your life, you need something called permanent insurance rather than term insurance. Term insurance is only for temporary needs. And when you get older, the cost of premium is gonna go up very significantly high. You can see it in this simple examples here. So we recommend people to have a permanent coverage so that whenever you are working, you are saving this much money. Like an example here, you are saving how much here? You are saving only like $2,700 every year. That's it. For the next 20 years, and after that they are saving nothing. And from the 20, you can see there is $500,000 coverage from the start, and it keep on increasing even in when they are getting older as well. And there is cash value which they can withdraw during their retirement as well. All right, now hope I answered your question. Anybody else has questions? Mithun, the WL insurance is having high CSP. Then what is the advantage of taking a universal life insurance? Very good question. The question is, there is whole life and there is universal life. Those are two separate products. Depends upon the client we choose which one is the right for them. Whole life has guarantees built into it. That means, let's say if it is with equitable life, for the past 30 years, they were paying a dividends of more than 6%. That means a guaranteed growth of 6% you are getting. But in universal life, you are investing in funds. The funds which doesn't have a guarantee. However, the good thing is the funds which we usually select, they are having a performance history of more than 10 years and having an averaging of above 10 to 12%. So that is the main difference between a universal life and a whole life. And again, in whole life, you are paying for that guarantee as well. It's not free. Hope I answered that question as well. Anybody else has question? Please feel free to unmute and ask the questions. Perfect. Any questions so far? Any question?
Do we provide hello?
Yes.
Good evening. This is Sai Kumar here. So do we provide services for the annuities as well?
Annuity?
Annuities.
Yes, Sai, we do annuities as well. We do with the equitable life and industrial lines as well, annuities.
Okay, so but mostly the services that we provide, it would be universal life and whole life. Right?
Not necessarily, Sai. I don't know from where you get this idea. We deal with insurances. Of course, we deal with only there are three insurances. One is universal life, one is whole life, and the one is term insurance. Anything for life insurance. There is nothing else. If a person need insurance, they have to choose from all these three. And we deal with the TFSAs, we deal with FHSAs, we deal with RESPs, we deal with RESP kids, RESPs, RRSPs. We deal with all those things as well.
Right.
Yes. So insurances are just one of the product we are dealing with. Okay.
Right. Understood.
Okay. Any more questions regarding insurances? And also, I want to talk one more about insurance. Some of you might be already studied about accident and sickness. Some of you are preparing. So there are two types of benefits which paid out from an insurance. One is income, one is lump sum. Income is nothing but you are getting monthly. So from a disability insurance, you are getting every month income. From a life insurance or a critical illness insurance, you are getting a lump sum money from the insurer, which is the insurance company. It is always like that. And what is the application procedure? How does it work? I'm just going to briefly explain that one as well. Hope you guys can see my screen. Okay. Can you see my screen, Dave? Harsh, can you see my screen? Okay, perfect. So what is the application process? How does it work? So in life insurance, how do we do the application is we do a first, what we do is something called financial need analysis, find what is the exact need and we find the right product for them. It can be universal life. If it is related to life insurance, like I was saying, only three options: term, universal life or whole life. Depends on the product, whatever. And what we will do, we will sit with the client and we will do an application. So with whatever the company it is, it can be with Equitable, IEA, so many other companies are there, right? And CPP, Vari, all those companies. Once we submit the application, it will be going to somebody called the underwriter. So the underwriter is the person who will be checking the application and approving. And he will be doing all the background checks and everything. There is no credit check. There is no credit check. There is no credit check in a life insurance application. And the underwriter will check everything, your health history and all those things, and they will send two output, either approved or rejected. If it is rejected, they will show a reason why it is rejected. Okay, so the approval doesn't mean it is in force. So when an insurance application is in force, that means if something happens to that person, the death benefit will be paid out. What is the difference between approved and in force? You guys all need to learn very carefully. So let's say it is approved, it will go to the advisor. Whoever your advisor, they will receive the email saying it is approved. So let's say usually what we usually do is we will attach a premium to the application as well. When we are doing the application, we will attach, like, put the banking details and attach the premium with it. So in that case, if the premium is gone, and the advisor will deliver the documents. Okay, once the delivery is completed plus the first premium is gone, then it is in force. So I will give you an example. Ramandeep, do you want to unmute? So Ramandeep, one of your client, you did a plan, let's say that is a term plan. So he's a very young student or something. You did a term plan, you submitted the application, you attach the, when you are doing the application, you put the premium with it. Okay. So let's say that happened on now what, October 29th. One of your client. Let's go by October 10th, you submit the application. It got approved on October 12th.
Okay.
Okay. And you didn't deliver the document, and October 14 something happened to the client and died. What will happen? Will the benefit be paid out or not?
No.
It will not be. Let's say you gave you a check for the first premium saying October 17. Okay, 17, and the client died on October 14. What will happen? Will
No
the
benefit will be paid.
exactly, it has to be delivered, and also the premium has to be gone from their account. Only then it will be in force. Okay, perfect. And I will also talk, I think we have a couple more minutes. I will also talk about something called a rating and exclusion. If you are preparing for the exams, keep these ones in mind. You are gonna get so many questions on these ones. So in rating is, let's say somebody is a smoker, that policy is gonna be a rating. That means, let's say it's a term plan, let's say he is paying only $30, like we are saying. But if it is a rated policy, he might be, I don't know exactly, he might be paying around $60 for the same term plan. Because your cost of insurance is gonna go a lot higher because you are a smoker. Okay, because the company is taking more risk on you. That is a rated plan. So exclusion is if your client is very adventurous guy, he goes for a deep sea scuba diving every month, not like one time, like on not or anything. He is going every month for a deep sea scuba diving, or he is going for like high altitude skiing or anything. So when the application, there is a question, if we put yes, there is high chance that there is exclusion. What does that mean is, if the client is dying due to that activity, there won't be anything paid out. So you understand the difference between exclusion and rating, right? Rating is for their permanent. Exclusion is only from some, if something happens to do to a certain things, it won't be paid out. Okay, that is the difference between rating and exclusion. Then there is something called incontestability period. Incontestability period. Incontestability period is nothing but it's a period that is 2 years. If we made an error in the application or anything, the company can find out and ask for the difference in premium, or they can simply cancel our plan. If we let's say if it is an intentional, we made it like to reduce the premium or something. Let's say your client is a smoker and he is telling he is not a smoker. And even if after 10 years, if something happens and when they are paying out the death benefit, they are gonna do a investigation, and in that they find out the guy is a smoker, there won't be any death benefit paid out because he lied on the application. Okay, so that is forgery, and there won't be any death benefit paid out to the client or the family. Okay, and if it is a mistake happened, it's not intentional. If that is in the first 2 years, like they can ask for a difference in a premium or they can cancel it as well. And if it is after that also, they can ask for a difference, but it should not be intentional. That is the main thing. Okay, any more questions? I can take a couple more questions and we will wrap up this today's session. Any questions so far? Please feel free to ask me anything. I can help you with your exams as well. No questions? Google, George, Ria, anybody has questions, feel free to ask me. Okay, I guess I gave some value to everyone. Thank you so much, and I hope you guys are clearing your exams and getting licensed soon. I'm so super excited to see all of your paycheck soon. Thank you so much. Much appreciated.
Thank you, Ajit.